While most of the world watches the U.S. national debt tick past $39 trillion, climbing by roughly $5 billion a day, a small fraction of the population has stopped looking at the numbers. When institutions show signs of fiscal strain, capital historically repositions itself out of plain sight. The standard playbook relies on shell companies, trust structures, and opaque private credit markets to quietly shield assets from the turbulence. Hiding money is a defensive move. The people closest to the financial system are now executing a more ambitious strategy. Rather than hiding wealth within a cracking system, the objective is to leave it entirely and build smaller, self-contained jurisdictions. Real estate listings are now hitting the market where sovereignty is the product. These transactions sell legal autonomy as a commodity, shifting the focus from physical buildings to the underlying jurisdictional control of the land. The era of simply hiding wealth is becoming obsolete. The new ultimate objective is legally controlling the underlying reality where that wealth resides. A stretch of land on the island of Roatan, off the coast of Honduras, offers a live demonstration of this concept. It's a development called Prospera, operating under a specialized legal framework allowing the private zone to write its commercial code and run its courts. Inside its gates, the effective income tax rate hovers at roughly 1%. And to separate the local economy from the fluctuations of national fiat, Bitcoin is accepted directly as legal tender. Decisions flow through a 9-member council, 5 elected by residents, 4 appointed by the corporation. Major decisions require a 2/3 majority, 6 votes. Because the corporation holds 4 seats, residents can never reach that threshold alone. The math guarantees an unbreakable corporate veto. In 2022, the Honduran government attempted to shut this down, repealing the law that allowed these private zones to exist. Prospera's backers responded by filing an international arbitration claim against Honduras for $10 billion, suing the nation for lost future profits of an unfinished city. Multinational corporations have long used international arbitration to protect mining or oil contracts. Applying these legal tools to a city shows these zones function as rival states, challenging a host nation's Supreme Court to keep corporate charters intact. For decades, the standard method for acquiring a foothold outside your home country was the golden visa. Wealthy individuals would inject capital into foreign real estate or bonds, receiving a passport or legal residency in exchange. That specific route is actively closing. The European Union has pressured member states to treat these programs as security risks, while locals in cities like Lisbon and Athens protested the resulting housing crises. Portugal shut down its real estate route, and Greece doubled its investment thresholds. But the capital isn't retreating. The market is shifting toward golden jurisdictions. Instead of buying a passport to enter someone else's legal system, the buyers are negotiating to write the rulebook themselves. This concept has deep financial backing from venture capitalists and crypto funds in Silicon Valley, who are funding a model they call the network state. The roadmap is sequential. First, you build an online community bound by a shared ideology. Second, you pool your capital to purchase a physical territory somewhere in the world. Third, you petition host governments for diplomatic recognition to legitimize the settlement. The pitch to host nations centers on promises of rapid foreign investment and new jobs. The required concession is total exemption from local democratic accountability, allowing the new zone to govern itself. The investors backing these pop-up communities are operating on a specific premise. Existing nation-states have accumulated too much debt and bureaucratic friction to be repaired. They view starting from scratch as the only viable path forward, which brings us back to the $39 trillion in debt we started with. When interest payments begin consuming a massive share of a national budget, capital naturally searches for an exit. Private cities offer a physical application of the lifebelt thesis. If governments scramble to cover ballooning debt by rapidly debasing their currency or increasing taxes, individuals in these private zones are shielded by fixed tax contracts and alternative legal tender. They are also insulated legally. Operating under a bespoke commercial code means your assets aren't exposed to domestic regulators or courts that might behave unpredictably under extreme fiscal stress. Economists and academics describe this mechanical shift as neo-feudalism. It outlines a structural arrangement where political voice, legal protections, and access to resources strictly scale with the amount of capital you bring to the table. The founders of these projects pitch a clean slate, a city stripped of legacy bureaucracy and optimized for efficiency. Yet the actual mechanics, like corporate vetoes hard-coded into voting blocks, explicitly lock out the people who live there from actual control. We are watching the globe sort itself into two distinct realities. On one side, self-governing enclaves engineered for those who can afford the exit fee. On the other, overburdened nation-states left to manage the aging demographics and the cascading debt. This division is happening right now in active court cases. Corporate councils wielding contractual supermajorities are locked in legal standoffs with the supreme courts of the countries they are built inside of. When the people who manage global wealth decide to build their own zip codes, rather than rely on offshore bank accounts, it signals an absolute loss of confidence in the nations the rest of us live in. The ultimate wealth protection strategy is building your own country.